Hi, everyone. I'm John Zaller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. While outside of the rate of inflation coming down this year, arguably the biggest key to the market's recovery has been the excitement around artificial intelligence, or AI, and its potential to have a transformative impact across industries. Joining me today for a conversation around AI is Tom Marra, Director and Portfolio Manager on MAI's equity team. Tom, thanks so much for joining me today.
Thanks for having me, John.
While artificial intelligence has been garnering investment from venture capitalists and top technology companies for years, I think it's safe to say that AI went mainstream in 2023, following Microsoft's announcement of a major investment into OpenAI, the creator of the popular AI tool, ChatGPT. And following that announcement, the floodgates seemed to open for technology companies to come out and address the market with their own strategies and investments in AI, which the market has ascribed value to as they're looking for any perceived beneficiaries from this trend. So, Tom, why don't we just start at a high level? What is artificial intelligence, and why does it matter now for investors?
I think that's a great place to start, John. So, when we talk about artificial intelligence in this context, we're really talking about machine learning. And machine learning is training models on large sets of data and then testing the model's output given the parameters that you've set. And so, at the risk of oversimplifying, for example, if you want the model to generate an image of a dog, engineers will train that model on large sets of data, images of dogs. And the parameters will be adjusted until the model's output is accurate. And you say, paint me a dog, and the model generates that. So ChatGPT is creating a ton of enthusiasm for these models. And it's an LLM, or a large language model. And it's trained on a huge body of language, mostly consisting of the open internet up to 2022, a ton of information. It has 175 billion parameters, which gives you a sense of how large these models are. And ChatGPT's jump in accuracy versus the past iterations was in part driven by the fact that it's just many times larger than its predecessors. And you can see that in the chart that we've shown here. ChatGPT just really stands out. And so why does this matter? I think we think, and market thinks, that there's enormous potential for these systems to increase productivity across industries as these tools are integrated into people's work functions. The thing to remember, though, it's still really early. There are complications we're just starting to wrestle with. For example, the quality of data that these models are trained on, super important. There's also potential copyright violations that we're just starting to get a handle on. So a ton of considerations, but definitely exciting.
Well, Tom, it certainly sounds like there's a lot of promise in this space, not without potential roadblocks as well, as you stated, with it being in such an early stage. But if you had to pinpoint who the likely beneficiaries are from AI, who comes to mind?
Sure. So I think we believe, and our research suggests, that the semiconductor supply chain will be a big beneficiary over the long term. And not to get too into the details, but it's important to kind of make it more clear. The compute intensity of AI is just much higher than legacy workloads. And when we break these processes down into their parts, first there's the training of these models, which we just talked about, and this takes specialized hardware. The models are only getting larger. There's only more use cases being applied, like media and video. So there's just more of them. And second, there's the inference part, and this is the output part. And this is where that magic happens. And if you've used ChatGPT, it certainly can feel like that at times. This is when you query ChatGPT to write you an email, for example. It tries to predict an output based on what it's learned from all that data it's been trained on. This is called inference. And the thing to remember is that it's considerably more compute intensive than your traditional search query on Google. And so these models will proliferate. They'll extend to images, video, and more people will be using them. So it's just more queries on more data. So it means we're going to need a lot more hardware. That said, I think right now, we think the market has already figured that out to a certain extent, and there will be ups and downs in investor sentiment. And right now, there's a ton of enthusiasm. The iShares Semiconductor ETF is up 47% year to date versus the S&P up 15%. Some specific stocks there are up much more. And you can see that in the chart, where the blue line represents the semiconductor stocks and the white line is the S&P 500. And this performance reflects what investors think will be huge investment in training these models, and companies are trying to build up compute capacity in front of that. Note, though, that with every new technology that has benefited semiconductors, whether it's PCs, smartphones, demand has always been cyclical. You build up capacity, and then there's the digestion of that capacity, which can typically mean slower demand for a period of time. Also note, I think which is also important, is that although there's a ton of excitement, there really isn't anybody making significant money on a consumer-facing AI application. At some point, these investments will need to generate a return.
Very interesting. And to your point, just about how the market is already pricing in a lot of the enthusiasm around this space, a targeted play on AI, it might not be the right time for that for investors. But putting yourself in the seat of our clients as they think through their overall portfolio and how to get exposure to this space, how would you advise those clients on how they might get exposure to artificial intelligence in the context of their portfolio?
Sure, John. So I think so far this year, to take a step back, the tech space has really broadly benefited from AI enthusiasm. And given the weights of the large technology companies in the S&P, it has provided a big lift to the index. So I think the way to think about this is that a well-diversified portfolio has exposure to these trends in a big way. And if you're right about the long-term productivity gains here, many companies will benefit from these efficiencies in places and ways that are impossible to predict with the information we have now.
Good points, Tom. And I think it just emphasizes the need to be well diversified, in your equity portfolio, because if you are, just by virtue of owning the top companies in the United States, you're going to have exposure to this trend. And second, just like the advent of the internet had an impact on businesses across industries and the way that they operate and the way that they make money, AI could be very similar to that. So I think it, again, makes the case for broad diversification, which has long been a key tenet of our investment philosophy at MAI. Well, Tom, thank you so much for joining me today and talking through this interesting topic. And to our clients, thank you for listening in. As always, we count it a privilege to partner with you in constructing and managing your portfolio to meet your unique goals and objectives. As always, if you have questions related to this topic or to your portfolio specifically, please reach out to your wealth advisor at any time. Thank you so much for listening, and we'll see you next time.